It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, the man himself, the mayor of real estate in the great state of Texas, Mr. Michael Becker. How are you?
Hey, Paul, doing pretty good. Getting the year kicked off here. So excited to see what 2025 brings.
Yeah, I mean, how would you describe your guys' position in 2024 and what's a little bit of what your crystal ball is saying in 2025?
Yeah, we sold 3 deals, bought 3 deals, and refinanced 3, I think was the final count for the year. So we're a little disappointed in the acquisition activity. We thought we'd do a little more, but it was a difficult year to say the least. Started out with rates kind of falling at the beginning of the year, and then going kind of out of January into February, rates started rising, and then they fell again, and then we got the rate cuts, and then they rose again, kind of going on the end of the year. So it's really up and down and choppy. A lot less transaction volume. Everyone's still kind of paralyzed. No one's by and large selling much unless there's a reason to sell. So the volume's been way off, and even though with a couple of the ones that we timed very well. Certainly with hindsight, got great numbers. So I feel happy with what we did. But, kind of coming in here, I think this is the fundamentals were soft last year. Overall, we're kind of just generally flat to down and down more in Central Texas and the North Texas for sure. But it seems like occupancies kind of stabilized as we went into the year. And generally speaking, about 93% portfolio-wide occupied, in January 2025 as we record it. So I feel like we're pretty well positioned from an occupancy standpoint. It costs a little bit of rental rate to get the occupancy on several deals, but I feel like 25 is certainly a recovery year as it relates to fundamentals. And, I've been saying for, seemingly 100 years now, but probably almost 2 years that I'm kind of feeling that, give or take second quarter 2025 is when we start feeling the supply fall off a cliff. The starts are way down, and so the deliveries are kind of one by one delivering, and there's less and less behind it. So I think your second quarter, as I've kind of noted many times, you'll start feeling that in Dallas-Fort Worth. Somewhere between April and June, and it might be later in the year or even next year in Austin, just because of the amount of supply. But I think Dallas, San Antonio, and I think you're probably already feeling it in Houston. We don't own Houston, but from what I can tell, the supply was much more muted there. So I think we're going to see fundamentals firm up quite a bit. Then we'll see kind of how values go. But I think values will probably follow the fundamentals. There's a ton of money, not a ton of inventory, and I think everyone's seeing the supply fall off, so they're trying to front run that. So I'd imagine we start seeing quite a bit of interest buy throughout the year. Certainly more on the Class A and lesser on some of the lesser located and the tougher assets as well.
We haven't asked you in a while, but I mean, you talked about you bought some transactions with good numbers, and maybe you could define what the hell that means. But you guys closed 3 deals that are closed in 2024. But can you kind of give me an example of a deal that you liked, that the good numbers, and what was the value add piece? Was it a stabilized property? Walk through maybe one deal that you closed that you can kind of give me just an example of what you're looking for.
Yeah, I mean, the deal last year we did, fresh in mind, right for about 3 months within a year, bought a infill deal in Dallas, late 90s product, 9-foot ceilings, had a parking structure, and it was in the 170s a door, if I remember correctly, range. So significantly below replacement cost. The dirt on that's very expensive, just being how well located and what neighborhood it's in. And the rents were low compared to its competitors. It had some value add opportunity by doing some renovations to the common areas and the units and kind of push rents that way. And we timed it pretty well. I mean, we got debt at like just under 5%. Fixed at 4.99, hit 4.99, and we said that's good enough. Let's lock it. As rates were kind of falling in August, we could have maybe got a little better. We would have got a little better if we would have waited a week. But then I was kind of kicking myself, and about a month later, when the rates started rising after the first rate cut, I was like, nope, we're good. That worked out well. So we were positive leveraged, pushing 75 basis points walking in. And then we had some room to really kind of push, and this was a pretty low supply submarket. So we felt that it'll kind of fuel the rent growth a little sooner here when the market starts to recover. So, a little early to see that yet, but I'm kind of really thinking that we get into March. If we're not seeing rent growth by March in Dallas, I might be a little more concerned. I'm pretty optimistic that we're going to start seeing some positive rent growth in March, which we've been flat to negative for almost 2 years now. So it'll be very positive to see. If we're not seeing positive rent growth by March and April, I'm gonna be a little bit more concerned.
If you were to have an investor walk with you on that property, what would they see, and how would you describe it to somebody that's listening here? I mean, what did it look like? How old was it? Was it two-pipe chiller? I mean, tell me a little bit more about that.
Yeah, so
physical
it was
characteristics.
it had 5 buildings, and it had a parking structure in between, building 1 and building 2. So it feels like a garden property, Paul, like surface parts, but it has a little bit more density just with the parking structure between those 2 buildings. A bunch of carports, late 90s vintage, good looking products. I think the architectural's nice on it. And so, mature landscaping. It's right across from major lake in Dallas, kind of like the most used natural amenity in Dallas is right across the street from the walking trails, biking trails, things like that. So, you have this real suburban feel, but you're like less than a few miles from downtown as well. So it was, really well located, good suburban location feel, but in the middle of the city. It's actually zoned a pretty good elementary school as well. So it kind of had a little bit of everything, but had some opportunity to do. It's in good shape and clean, but has some opportunity to do some value add on the inside.
So you bought it for what, 170 or so? How much money are you going to put into the deal?
Yeah, we'll probably, between everything, we're probably I don't have it in front of me, but probably around 10,000 a unit. Some closing costs. So we'll be kind of call it in the 180s somewhere, generally speaking, on the transaction. And there were several comps that traded for inferior locations and similar vintage at the peak for 30,000-40,000 a door higher than that. So I mean, obviously we're off the peak, but not too recent past inferior product and locations traded for substantially higher. So we feel pretty good about the relative value in the moment in time, and then we felt really good about the debt execution and have positive leverage with the debt that we put in place.
So the rule number 1, Michael Becker's rule number 1 is don't buy something in the hood. People that live on this property, their kids go to the same school system, have the same teachers of competitors of homes, which would be a direct competition. Everybody needs some place to sleep at night. What do those homes cost in and around the area that you just paid $170,000 a door for?
Yeah, the average
190.
Last summer, the average list price in the neighborhood was Lakewood and Dallas, where it was I think we're around $1.9 million was your average list price. So they're zoned to the same elementary school that multi-million-dollar homes are. So that's the average price. So some less and quite a bit more as well. So, mature infill, fully built out, established neighborhood. So if you want to build something, you got to tear something else down. There's no vacant land. It's one of the better neighborhoods in all of Dallas-Fort Worth.
Did you ever think about building a brand new multifamily property? Because a lot of people have been doing that for the last couple of years. They've kind of slowed down recently, but was that ever the game plan for SPI?
No, there's a lot more ways to mess that up. So, it's business hard enough without making it even harder on you. So, I mean, it's great if it works well. I mean, the people that sold properties in 21 and early 22 made probably life-changing money. But if you started a deal in early 22 and you're trying to sell it now, it's a completely different thing. And having, the shorter bridge loans that by nature construction loans are, you're starting something and the world could be completely different 3 years later when you're trying to sell it. So a little bit more risk with that. So it just seems to be great for the next guy, but not so much for me. But there's nothing necessarily wrong with it. I mean, if you do it right, obviously you're building it below what it'll be worth, and the effort and risk that you took by getting the land and taking the debt out and doing the whole improvements. Expected to have a profit, have a lower basis in it than if you just bought it from them. But there's certainly a lot more risk, and you have a lot more time before you start collecting rent from when you buy that land and start building.
We're recording this towards the middle of January of 2025, and you and I and about 10,000 of our closest friends are headed out to Las Vegas coming towards the end of the month for the National Multifamily Housing Council meeting in Las Vegas that happens. it's been Las Vegas for this is the first time it's been there. It was in San Diego last year and it was in Las Vegas the year before, but I think they're supposed to have 4 or 5 years in Las Vegas and maybe it's going to go over to Orlando, but whatever. Talk a little bit to me about making a visit to the National Multifamily Housing Council. What is it all about? Should new people who just get into the business, should they go there? Any idea what the cost is? What do you learn when you're there? Why do people go? Lots of questions to unpack.
Yeah. I mean, it's the who's who of multifamily. So every major brokerage shop and brokers in all the different markets across the country, all the major owners, lenders, management companies, everybody by and large is there. So it's kind of really a deal makers conference. They have educational events and stuff like that, but the vast majority of everyone I know, no one ever goes to any of that. It's all about trying to either buy or sell or find equity, something like that. So we'll, being in 2 markets, North Texas, Central Texas, and living in the areas, we don't really take a lot of meetings with brokers. But if you were an owner and you're in California and you own in Texas and Florida and South Carolina or whatever, it's a great time to take meetings because everyone's all in one location. Brokers is kind of like speed dating. So, they'll probably have, typically 15 to 20 meetings a day for a 2-day period. And then there's parties at night and a bunch of informal stuff on top of that. So it's a way for them to be very efficient, meet a lot of people, but it's kind of speed dating. So it's really, you can't get super deep because these meetings are 30 minutes and then you're on to the next one and the next one. For us, we'll probably have 12 to 14 meetings, predominantly with potential equity partners. And then I'll run into people that I know from town and we'll kind of have some casual conversations about this or that in the hallway. Or I'm going in on Sunday to watch AFC and NFC championship football games like I do every year. So there'll be a bunch of brokers and people from Dallas. So I'll get a little bit of opportunity to talk to a whole bunch of people on Sunday as well. So that's kind of it. But yeah, if you're brand new, it's probably a little bit overwhelming, a little bit overkill. If you live in the same market that you do business in, it's probably less necessary. But if you're trying to, meet with a bunch of different people in various markets or equity providers, like we're going to talk to a whole bunch of different potential equity partners from all over the country, it's a good use of time. And for me, it's a little bit of FOMO. If I didn't go, I'd feel like I was kind of missing out on something. And we actually have gotten a few deals. I think even sold some deals over the years here. So it's paid for itself over and over again. If you have to join NMHC and get I think usually the basic membership with a couple of tickets is like somewhere between $6 to $8,000, and you get other events. But this is an event that the only event I go to is this one. So it's not inexpensive, plus airfare and hotel and all that stuff on top of that.
I know that they're trying to promote women into the business. I mean, you go there and there's 10,000 people and 9,950 people are men. And I know that they've been talking for the last 2 years trying to encourage more women to get into the business, which at Old Capital, we're definitely trying to hire more women loan officers to be in this and really try to promote women into this business. But I think that, and I don't know if it is, but you can take a look online and see, not so much for this year, but maybe for next year. You can take a look at N as in Nancy, M as in Mary, HC.org and see if they can offer you a free ticket to get access to the event for next year. Again, I think it's for somebody that's a woman that's new, and if you can get a free ticket and you don't have to spend the $6,000, it's worth the flight out there. But if you haven't got a business going yet, and you only want to stay in 1 or 2 markets, it's better not to go there because you will be overwhelmed with just too many people, too much craziness that goes on out there. So I'd say stay at home. But really my question this year is, are people, what they usually do to go to NMHC is they bring transactions. So if you're a broker in Austin, as an example, and you're going out in January, like Mike was saying, is you may bring some transactions that are about to be listed for sale, or they may be off-market deals that they're trying to find the right person. And a lot of people who come there are looking for opportunities, inventory, something that maybe has not been exposed to the market. What's your take this year, Mike, about brokers bringing listings or off-market deals to this event? And is it a lot of deals you're going to see, or what's the kind of, we talked about this a little bit, just the state of the market right now to find those deals?
Yeah, like I mentioned earlier, it's a deal makers conference, right? So that's what a lot of it is people bringing listings. And this is like probably the highest point of the year to have listings is generally beginning of the year. And the second highest point is probably like August, September for kind of deals they're trying to close right before year end, and they're just not much signed up. We're less than 2 weeks as we record it from about a week and a half out before we get there. And like no one's got nothing basically. I mean, there's very, very limited deals signed up. So I think it's going to be, well, we might have these deals in the future, but there's not a lot now. It's going to be, it's quiet, so with the little that is on the market, I fully expect it to have a lot of interest, lots of tours, probably get a little better pricing just because of the scarcity that's out there right now. That's my read. I think it's all the way from Class A brand new stuff all the way to, your workforce housing. There's just not much of anything out right now. We've seen the rates really run since the Fed cut in September. 10-year Treasury went up about 110 basis points. So now we'll see how this is when you guys are listening to this a couple of days after we record it, but the Treasury started rallying and the yields are starting to fall a little bit. So we'll see if that turns into a trend or it goes right back up. But, we were testing 475, 480 on the 10-year Treasury, and it's off 15 basis points or better from that point. So we'll see if it tests 4% again or 475 first. I don't know which one, but certainly be helpful if the rates go down. I think if rates go down, then it'll be a little bit more supportive, higher valuations, and more people willing to go and try to meet the market. So, yeah, but it's eerily, to answer your question, Paul, it's eerily slow. I'm not quite sure what the hell we're all going to talk about out there because there's not that much going on. And we'll do a recap after this and we can tell everyone what we actually did talk about. But that's kind of my 2 cents right now.
You guys at SPI, you guys pay for third-party property management. You guys do not manage your own properties. What are some of the things that you're hearing from the property management groups, the property management company that you hire and that actually physically are on your property day in, day out? They talk to the tenants and something has to be escalated. They go to your asset manager who oversees some of the portfolio. What are you hearing from operations these days? Rents good, flat, occupancy? What's the rubber meet the road right now?
Yeah, we actually picked up occupancy in Q4, which is the slowest historically, but came at the expensive rental rate in a lot of cases. Again, Central Texas is tougher, so Central Texas is still kind of seeing negative rent growth. North Texas is kind of found its level. I think Central Texas large by and large is also found its level. So, but I mean, I think we fully going in, we've been kind of playing defense for 18, 20 months from an operational standpoint. And, the conversations that come, like we're going to play offense now. We need to push. And I think we fully expect that when leasing starts picking up, the weather gets a little better. So in Texas, that's generally around March 1st that we expect to see, leasing demand stay. It has been robust. We leased a lot of units this year everywhere across the Sun Belt, across the country and Sun Belt, and Texas included. We lease, probably, I think I read posts from Jay Parsons, who's now at Madera, formerly RealPage, how it was, I think, the second highest year on record for absorption behind 2021. It's just that the supply outpaced it, so the rents kind of went negative. But I think we're, by and large, expecting demand to still be really high. And there's going to be a moment, an inflection point, again, around the middle of the year where supply falls off a cliff, and it's going to be from way above historical norms to below historical averages. So I think that's going to be felt first in North Texas and a little bit later down south. So I fully expect that we're going to see rent growth. Been more aggressive on the labor front too, Paul. I think that, with COVID and all the stimulus and everything, I think that everyone's a little bit worried about, we let this employee go, can we find somebody else any better behind them? And I think, that got everyone a little soft, and we had tremendous rent growth for a couple of years there that didn't matter as much because it was kind of covering up a lot of those issues. So now a lot heavier hand with the employees and making sure the maintenance guys does everything in house and not contracting this or that out. And so I think we're seeing some of that. I think we're seeing taxes start to settle some of the 24 numbers, and we're seeing either no changes to negative going backwards in 2023, which is great to see. That's kind of what I figure is going to happen. Still more to go. We haven't settled that many, but the kind of early indications are we should be flat to negative kind of across the board for 24 over 23, as long as it wasn't purchased in that year. So it's kind of for the legacy asset. So I think that's what we're going to see. It might take me another 6 or 9 months to get there, but we're starting to see some fruits of that labor early. So we'll see if that plays out wide scale, which I think it will. And then insurance hopefully doesn't creep back up. I don't think the wildfires in California are going to affect multifamily properties in Texas, but certainly won't help having $200 billion in damage in Los Angeles won't help the insurance market overall. So we'll see kind of how that impacts. But I kind of think it's gonna that big surge of insurance is kind of moderated and shouldn't be nearly as impactful in 2025 renewals as it was in the recent past.
So you own a house, I own a house, a lot of people rent. And I think that's kind of the nation of, to a certain extent, of renters these days. I was listening to what the new conforming loan limits are of on just the single family business. And it's like over $800,000 in, think of $800,000, whatever rates are on, on a conforming loan. Let's say they're 6.5%, 7%. Jumbos maybe are higher than that. Again, you have to qualify for that amount of loan dollars. I mean, I don't know how people pay a mortgage these days, which could be, if you're talking about $700,000 or $800,000 loan amount, because the maximum again conforming is $802,600, something like that. I remember when I got into banking a long time ago, the conventional number for Fannie Mae was like $110,000. So it's gone up from 110 up to $800,000+. So I don't know how folks these days, your kids, my kids, our nieces and nephews can afford homes. So they're looking for opportunities outside of owning a property. What are you seeing right now? I mean, for you, Mike, what are you seeing for your occupancies higher? I mean, that they've kind of stopped building apartment buildings because the interest rates went too high. And so are people jumping from apartments to buying homes these days? Or is that what you're hearing?
Yeah, I think still there's always people moving in and out and buying homes, but I do think it's on a percentage basis is going to keep people in the rental pool a little bit longer on average than maybe historically until that affordability metric gets a little bit more in line. So yeah, I think that's probably supportive of higher occupancies overall. And now that we've been experiencing a ton of pain for 24 months with the new deliveries, and we're seeing 6 months or so or less lights at the end of the tunnel in the majority of the country, majority of the Sun Belt. I think all these landlords are going to be the beneficiaries of higher rates and the way the system works and people set rents nowadays. I mean, it's been great to be a renter, much more attractive to be a renter the last 2 years than it has been to be a homeowner.
Sure.
And they've been largely benefiting in with negative rent growth and the rents going down if they move around or maybe a big moving special. So that's going to by and large go away. And I think the way we all price rents will make them go up a little quicker. So what goes down quick can probably go back up quick. I don't know if we recover everything and that we lost in 12 months, but I think we start picking away. And I really do feel that 26 and 27 are setting up to be two very strong years. I know there's consensus at this point, but I've been saying that for 2 years now. Really, ever since Silicon Valley Bank and First Republic failed, it became very, March of 2023, it became, next to impossible to capitalize a new construction deal. So the volume is really, really falling off. So I think that there's going to be a backside of this, and I can't wait. Keep telling myself that. So I can't wait to see it and see the fundamentals. And then, if the Fed continues to cut, even if at a slower pace, that'll be helpful. And, our Treasury, the yields on the U.S. Treasury bonds are dramatically higher than most other places across the world. So I think that also probably likely puts some sort of governor on how high they can go because it can make the dollar surge and so forth and so on. So, I mean, at some point, I think these rates will probably start going down directionally. Not saying it's going to stay down or it might be a yo-yo. That's kind of what seemingly has been going on for the last 18 months. They'll go up and there'll be a moment where they go back down. And then, if you have to refinance, you start seeing a trend, get your stuff together, talk to Paul, talk to James, talk to one of the guys, get ahead of it, be organized, and, make sure maybe it's worth specing an appraisal and a environmental report to lender that are good for 6 months that, you have that moment in time when, the rates kind of cross over, your revenue gets a little bit higher, maybe you knock your taxes down and these interest rates come in. There might be a moment in time where that thing works, and it might only be there for a week or two and the rates might go back up or something might happen. So I would be as proactive as you can be. It's much more important to be proactive and ready than in normal times when it's not as volatile. So that'd be some unsolicited advice right there.
I love unsolicited advice because you help everybody that wants to get in this business and stay in this business, and you do things the right way. So I do appreciate you spend some time with us on Ask Mike Mondays. If people wanted to get more information about what you do, Mike, what's the best way for them to get a hold of you? And again, explain what SPI does.
Yeah, so I think the best way is simply just go to our website, which is spiadvisory.com. It's SPI like spy with an I, advisory.com. There's a contact us form. You fill that out. You can get in our database. You can get our quarterly newsletters that I write and learn about potential opportunities, which you hope to have several in 2025 to put out where we raise money and do some deals. We were a little slower last year than we want, but I think we did more than most. And where we feel, in my 2 newsletters ago, I kind of coined it a generational buying opportunity. I think this is the best time to buy multifamily and, probably since 2012, give or take. I think we're kind of off the bottom on the nicer Class A stuff. It might be a little more pain on the workforce, even though I think we're probably pretty close on the bottom on the workforce as well, especially if rates come down. And, I'm just optimistic. So those of us that have the courage over convictions and can take action, I fully believe in 2028, I'm selling all these deals for a big profit that everyone's going to say, I wish I would have done this. I wish I would have done that. So, and it's not freaking easy right now. Everything's hard. Every transaction's hard. The debt's hard. The equity's hard. Operations are tough. I think we're going to start going from only headwinds. We're going to start seeing some tailwinds, especially on the operational side. And, hopefully we'll kind of then translate into a little bit easier lending environment. And that certainly would help lending and then, capital markets and then what are people willing to pay will start kind of recovering here. So I think 25 is the recovery year and 26 and 27 should really kind of accelerate. So if you haven't bought and you want to buy, now's a pretty good time, but it's hard. And, I would certainly look to guys like Old Capital guys and gals over there and really help you kind of be in your corner when you're navigating the debt market because it is very choppy and disparate right now. So you need someone that kind of help you look around the corner, see some stuff and get you at the right place and solve problems because every deal has a problem with it. And there's always some point of conflict that you need some help with that I know that Paul and his team does a good job with.
Well, I appreciate that. Again, we view it to try to help people being education of what's going on in the market. We don't want to see anybody lose any money. So I've done this for such a long period of time that people come to me and just continue to ask me questions about how to structure these deals. What's a good area? What's an area that I shouldn't be in? I mean, these are people even from California, but also people from Dallas wanting to know what's going on. And so what we have done, we did it in January. We're probably going to do it in March. We're going to do another bus tour. We put 50 people on the bus and we just kind of drive them around. It's a nominal fee. We'll do it for a day or day and a half. And we'll drive you around and show you the transactions that we've closed or transactions that are available for sale, how they were structured. We'll get off the bus. We'll walk onto the property. Mike was gracious one time last year. He walked some properties with us. He was open for questions, and he went through a couple transactions that the guys over at SPI had completed and owned. So that is I would say this is the first step. If you're thinking about getting into multifamily, the first step is really probably to become a limited partner and see what it's like to invest in the deal. And I'm talking about putting $50,000 to $100,000 in, not $10,000, not $10,000, not $25,000, but $50,000 to $100,000 and find a group that you can trust, that you listen to, that has a track record, and that's how you can kind of mitigate the risk. But you got to know really what's going on, and that's where the bus tour, I think, comes in and tries to help people about really what's happening. We're not mentoring, we're not education on that piece, but we're bankers, and we know what works and what doesn't work. And I thought it was good that Mike, which he comes from the banking side before he became an owner of real estate, he was great about understanding when he was lending people out what this was all about. So I remember he worked for Wells Fargo as a commercial real estate guy. So he had a lot of swings of the bat to help people understand. That's what helps. Either you're a banker or then you're also maybe a limited partner on one or two deals, and you can kind of see how those people have done it. And then you kind of frame on how you would want to do it if you were given the opportunity to try to buy these properties. So go to oldcapitalpodcast.com and see if you can join us for the next field trip. And that's sponsored by a bunch of brokerage groups and ourselves here in the Dallas-Fort Worth area. And we'll bend Michael's arms maybe next in March to come out and spend some time with us, and you get to know him a little bit more. So Michael, thanks for the time. We certainly do appreciate it. Again, that was Michael Becker. I'm Paul Peebles. Have a great day.